Hey, thank you, Kelly, and welcome everyone. We've all heard the headlines about retirement security in the U.S. For example, more than 40% of Americans are at risk of going broke in retirement, and that's the good news, is one. Another, most Americans nearing retirement who should be saving are saving. And my personal favorite, you're probably not saving for retirement, and that's okay. Clearly, there's much debate going on about whether there is a retirement crisis in the U.S., and if so, what its magnitude is. Getting this analysis right is critically important as policymakers consider reform proposals geared to increase retirement savings and reduce the retirement deficit. I'm Lori Lucas, President and CEO of the Employee Benefit Research Institute, and I'm happy to present our e-briefing addressing these topics and more. In today's Analyzing Policy and Design Proposals webinar, EBRI's Research Director, Jack VanDerhei, will provide analysis from several different perspectives using his retirement security projection model. The webinar will be moderated by American Funds research leader Brett Hammond, who has done considerable work in the area of evaluating retirement income replacement in his own career. We will cover a lot of territory in the e-briefing, including assessing the current aggregate national retirement deficit, as well as the potential impact of various retirement reform proposals on that deficit. We will also leave time for questions, so please enter them into the Q&A box on your computer screen as we go, and we will answer as many questions as possible at the end of the session. And now let me turn it over to Brett Hammond.
Thank you, Lori. This is Brett Hammond from American Funds and Capital Group. I'm really thrilled to be asked to do this because I think that the EBRI model and the work that Jack and his team have done have really informed discussions and the agenda, and have even informed researchers in the work that they're doing, including people like me. The model that they have built is something that no one else has because they've got access to the data, they've done the work on the modeling that really helps illustrate things. Now, note that this isn't about any individuals. This is an attempt and a successful attempt by Jack and his colleagues to look at in the aggregate and at issues that are of importance to the nation as a whole, including legislative and regulatory proposals that are on the table. So I think that's a really significant part of all this, is that it's helping the nation think about this problem rather than being, let's say, an individual advice model. So without further ado, let me turn this over to Jack, who can walk through some of the things Lori mentioned and others, and then we'll come back to field some questions. And I have a few of my own, so get your questions in early so we can address them. Jack, why don't you take over?
Well, thank you, Brett. Thank you, Lori. It's an honor to be here today to talk about some of our most recent results from the EBRI Retirement Security Projection Model. Just as a little bit of history, this is actually a model that Craig Copeland from EBRI worked on with me going all the way back probably to the mid-90s. Originally, we received some seed money from the Milbank Memorial Fund because governors of certain states were very paranoid about what would happen to future cohorts of retirees when they basically started to run short of money. Their primary interest, of course, is that once one becomes financially indigent, that the states are more or less on the hook through Medicaid for things like nursing home costs. So we started to put together this model. Basically, we did one for Oregon, one for Kansas, and one for Massachusetts in the early 2000s. And then in 2003, instead of deciding to come out with 50 different state models, a theme that's probably going to come back later today when we talk about auto IRAs, we decided to just consolidate it into one national model in 2003. We've done several studies based on that. You'll see a URL at the very last slide to get some more information on our studies. But in 2010, we went through a major revamp and redesign of the model. After PPA was passed, obviously there was a situation where so many more 401k plan sponsors were adopting some type of automatic enrollment that we had to reflect that. We also reflected the financial and real estate crises from 2007 through 2009. And basically, we've updated it on a regular basis since then. Many of the underlying data points will be upgraded or updated every 3 years. And right now we have a model that, although are basically using parameters in many cases from 2014 and 2015, have still been updated to give us the most recent information. So what I want to do is a quick outline of what we're going to cover today. I'm going to give you a brief description of the model, and I apologize in advance for some of the detail I'm going to go through, but as Brett mentioned, this is a model. It's different from anything else that's being used to do retirement income adequacy projections. We're not, for example, relying simply on things like replacement rates. We have both an accumulation and a decumulation module run stochastically, so I want to just run you through that quickly because it's very important when we start talking about things like retirement success and retirement deficits that you know exactly where those numbers are coming from. Then we'll get you into some results. I'll go through what's the probability that U.S. households currently 35 to 64 will have adequate retirement resources. I'm sure one of the questions that will come up if I don't mention it myself is why don't we do younger age cohorts? It's extremely difficult until people are around age 35 to get enough information on them to have really good predictions on what their future age wage curves look like. So we've been expanding that into younger cohorts and some of more recent analysis. But in terms of putting everything on one consistent footing, we're just going to do 35 to 64 today. We're also going to look at how that probability of having adequate resources varies with future defined contribution eligibility. And obviously one of the reasons why that is so important is so many of these proposals today are looking at how to fix the quote coverage gap by having more workers eligible for defined contribution plans. So we're going to try to very quickly summarize just how much of a difference those might make. Then we're going to move from just a simple probability because somebody might not have an adequate amount of retirement income, but it might turn out that they're only missing it by a couple hundred or $1,000. So obviously how much they miss it by is going to be important. So then we'll look at the aggregate retirement deficit for those with inadequate resources. And I'll also look at how that varies not only by age, but also for future eligibility for defined contribution plans. Then we'll get to the part of this that I think is going to be most interesting is how do some of the recent retirement reform proposals actually reduce those retirement deficits. And I'm sure it'll come as a surprise to virtually no one in the audience that it really depends to a large extent on how old you are. If you're on the verge of retirement and suddenly you get put into a defined contribution plan for the first time in your career, it's probably not going to have enough time to make a lot of difference. So we'll be focusing most of the discussion when it comes to these proposals on our youngest age cohort, basically those 35 to 39. Then we're going to look very quickly at the impact of leakage, at least on the automatic enrollment plan participants. Sarah Holden from ICI and I did some work on the voluntary enrollment participants earlier that I can refer you to. But since more and more of the 401k plans are going towards automatic enrollment, I'm going to focus on that. And then one of the proposals that have come up recently to try to deal specifically with the most pressing leakage problem, that of cash outs, is automatic portability. And so we're going to give you some runs on how much auto portability would help. We're also going to look at some proposals that aren't necessarily going to be helpful in terms of retirement income adequacy. There seems to be at least one call every year to decrease the limits on how much one can put into a 401k plan. So I'm just going to pick some almost ad hoc thresholds as far as reductions of both the 402G and 415C limits and show you what decreases in those limits would do to account balances at retirement. And then we'll spend some time trying to just quickly summarize everything we've gone through. Okay. As far as the model is concerned, like I said, we have both an accumulation phase and a retirement phase. I'm not going to go through all the detail, but just so you understand where the most important parts of this come from is we simulate either retirement income or wealth to retirement age, which for today is going to be age 65, although we can vary that, for households from defined contribution, defined benefit, IRA, Social Security, and net housing equity. And we basically have the information to do that on the defined benefit side based on pension plan parameters coded from a time series of several hundred plans. So we're able to incorporate, for example, the fact that there's been a shift over time from, let's say, final average plans to cash balance plans, etc. For the 401k part, we have participant behavior based on individual administrative records, so we know exactly what they're doing literally to the penny. And this is from annual linked records dating all the way back to 1996 from the EBRI ICI 401k database. As far as Social Security, we're going to use the current statutory benefits for the baseline, but if people would like to see what happens if the trust fund goes to zero and there is a pro rata reduction in those benefits, just send me an email. We also have much sensitivity analysis based around that. So I take everybody out to age 65. On the retirement phase, literally the most important things you hear financial advisors talk about it when it comes to retirement risks are longevity risk, post-retirement investment risk, and long-term care risk. So we have to be very careful in doing that on a stochastic basis. And we simulate 1,000 alternative life paths for each household starting at 65. When it comes to how much you're going to spend each and every year, we have both a deterministic part and a stochastic part. Deterministic part, as long as we know your age, your wage, and by wage I'm just going to basically say we use your post-retirement income based on a proxy of what you have available, and your marital status and whether or not you have a house. From that, we're able to get pretty good information on average cost for things like food, apparel services, transportation, entertainment, reading, education, housing, and basic health expenditures. That's not going to vary too much from year to year. Where you do have a lot of variability, though, we have to rely on stochastic modeling, and that's where the longevity risk, the investment risk, and the long-term care costs come in. Okay, so then the next thing we have to focus on is when is a household considered to run short of money in our simulation model? Again, we're not going to simply take you out to 65, compute a replacement rate, and say, does it meet some ad hoc threshold? Here we look to see if aggregate resources in retirement are not sufficient to meet average retirement expenditures. And this version of the model is constructed basically to simulate retirement income adequacy. If you're interested in other more conventional ways of doing this, we're certainly able to do it, replacement rates, standard of living calculations, and other ad hoc thresholds. But we think this is probably the most important way to look at retirement income adequacy to see whether or not people will run short of money in retirement. So the baseline version of the model is going to assume everybody retires at age 65, that they immediately begin drawing benefits from Social Security and defined benefit plans, if any, and that to the extent that the sum of their expenses and uninsured medical expenses exceed the projected after-tax annual income from those sources, they immediately begin to withdraw money from their individual accounts, their defined contribution plans, cash balance plans, as well as the IRAs. Now, when a household is considered to run short of money, if there's sufficient money to pay expenses without tapping into the tax-qualified individual accounts, then those balances are assumed to be invested in a non-tax advantage account with investment income as taxed as ordinary income. And then individual accounts are going to be tracked until the point at which they're depleted. At that point, if there's any net housing equity available for the household, They assume it's going to be added to retirement savings in the form of a lump sum distribution. We don't assume that, for example, somebody age 75 suddenly decides to buy a reverse annuity mortgage. And then if the retirement savings are exhausted and if the Social Security and defined benefit payments are not sufficient to pay expenses, then the household is designated as having run short of money at that particular point. So we're tracking a lot of different moving parts here, but again, we're trying to do this, and for each household, we do this 1,000 different times. Sometimes they'll have a life path that's very short after retirement. Sometimes they'll go well into the 90s, and maybe even the 100s. So we're basically trying to accumulate all that various information. The very first figure I'm going through is the retirement readiness ratings with and without long-term care costs. And again, this is for all households between the ages of 35 and 64. And what I'm doing here is giving you two different sets of columns. The one on the left is with the long-term care costs included, and the one on the right is without the long-term care costs included. Now, if you look at the very top number on the left-hand side, this is more or less of our baseline. This assumes, as far as those deterministic costs, based on the demographics I mentioned before, that you spend 100% of the average. If you spend 100% of the average and you include long-term care costs, then basically 57.4% of all of those households will not run short of money in retirement. So you can think of that as a 57% probability of success. If, on the other hand, you think that long-term care costs should be ignored when you do these calculations, go over to the right-hand side and you see that 57% goes up to 75%. Now, going back to the left-hand side for a second, what if you say, well, that's nice, but I think if people realize they have limited financial resources, they're going to start cutting back immediately on things they can control, on those deterministic costs. So another number I model is, let's assume that instead of paying 100% of the average cost, you're only consuming enough to have 90%. In that case, you can see the probability of success, including long-term care costs, goes up to 68%. And furthermore, if you want to say, well, that's not enough, let's assume it might be only 80% of average, then you can have a number, a probability of success as high as 82%. As you would guess, if you moved over to the right-hand side and look instead at those 80% expenditures and no long-term care costs, then you can get the probability of success up as high as 91%. So not surprisingly, what's the right number for the overall probability of success for this cohort between 35 and 64 is going to depend on the assumptions. Anywhere from 57% to as high as 91%, depending on whether you want to include long-term care costs and whether you want to assume they're basically having deterministic expenditures equal to 100% of the averages. Now in figure 2, what I do is give you exactly the same information, but I break it out here just for Gen Xers, and I look at how many future, can't do anything about the past, how many future years of eligibility you have for a defined contribution plan. And if you look at that first number, these are the people unlucky enough, the Gen Xers, who will not have any eligibility for defined contribution participation from now until the time they retire. So the selection of employers they have from now until the retirement time, none of them will even offer them a retirement plan, a defined contribution plan. In that case, they have a 48% probability of success. On the other hand, if you go to the other extreme and you look at those people who are fortunate enough, as far as future years, to work for an employer who offers a defined contribution plan, whether or not they choose to participate, we're grouping them all together, then you have an increase in probability of success going from 48% all the way up to 72%. So I think it's a very powerful way of showing just how important eligibility going forward in a defined contribution plan is going to be. Now in figure 3, we move beyond just simple 0-1, you're successful, you're not successful, you ran short of money, you didn't run short of money, and we go into, if you do run short of money, just how much is it? So again, I take those same group of people, 35 to 64, this does include long-term care costs, and say how much at age 65 in present value terms on an after-tax basis, everything combined, would need to be added to those retirement accounts so that basically nobody runs short of money in retirement. And that number gives you the number on the top of the green bar. It's $4.13 trillion. Now again, that's assuming everybody has 100% of the average expenditures on the deterministic side. If you want to relax that assumption and assume it's only 90%, then basically everybody who runs short of money is going to run short of money to a smaller extent, and basically you've got about a 50% decrease from 4.13 trillion down to 2.09 trillion. And if you really want to be heroic with your assumptions and assume people only spend 80% of the averages in retirement, then we can get that present value of after-tax cost, or the retirement savings shortfall, all the way down from 4.13 trillion down to less than 1 trillion, $0.7 trillion. Now in figure 4, we take that same concept, this retirement savings shortfall, this present value of deficits at age 65, and we break it out not only by age, but again by how many future years of defined contribution eligibility you have. Now, I'm only going to focus on the people on the left-hand side, the youngest group, 35 to 39, but you can probably just eyeball over and see that in many cases, when we control for how many years of future eligibility you have, the numbers tend to be larger for the younger individuals. What's going on here is basically the growth rate for things like long-term care costs are higher than most of the inflation's estimates that we have, for example, in deterministic costs. So the younger you are, basically the larger your average retirement savings shortfall is going to be. What we find in the very top number on the left-hand side is that for people currently 35 to 39 who are unlucky enough to have all their future years of work with an employer who does not sponsor a plan, you have an average retirement savings shortfall of $88,000. Now, how much does defined contribution eligibility? Again, just because you're eligible doesn't mean you're going to participate. How much does that matter? Well, if you go all the way down to the bottom of that first column, for that same cohort, 35 to 39, the average retirement savings shortfall drops from $88,000 to less than 25% of that, to only $20,000 on average per individual. Now, that basically sets the stage for let's go and have some fun analyzing the different proposals to reduce those deficits we just looked at. And we basically run 3 different scenarios in what I'm about to show you. The first one is very similar to the federal auto IRA proposal that the Obama administration had in several of its budgets. However, I'm going to apply this to all employers regardless of size. We do know that in most proposals, some of the very small employers, for example, those with less than 10 employees, might have been exempted. So basically, anybody in this scenario who doesn't have a DB or DC plan is going to be offering their employees, is going to be putting their employees into an IRA at 3%. Now, those employees can choose to opt out, but at least at the baseline, that's where we're going to start. There are no employer contributions going into this. I'm assuming no employer behavioral reaction, so I'm assuming if you did have a defined contribution plan, then suddenly there's a federal auto IRA. We're not going to say, well, we're going to dump our DC plan and go with the auto IRA instead. Second thing that we look at is the most recent plan that's been put forth by Representative Neal on the Automatic Retirement Plan Act. And basically, we're looking at a situation here in which we're going to start you out at 6%. We're going to have this automatically escalated over time, and then basically every 3 years we're going to come back and we're going to auto-enroll you again. So if you had been auto-enrolled and you decided to drop out, 3 years later we're going to come back and put you in at 6%. The auto-escalation will go up to 10% under this particular proposal. And finally, not that anyone has actually proposed this, and in fact the way people run away from the mandate word, I don't think this would be likely to show up anytime soon, but more or less just to give you some frame of reference for how much could we improve this if we wanted to. I model something called a universal defined contribution scenario, where again anybody who doesn't currently have a DB or DC for their employees chooses a defined contribution plan, but instead of just simplistically saying every employer who doesn't currently have a plan will adopt the same kind of DC plan, what I do is I look at the size of the employer, I look at the types of plans typically in place for employers of their size, and then I just do a random selection among those and generosity parameters to come up with what they're going to put in for them. So some will be voluntary enrollment, some will be auto-enrollment, some will be auto-escalation. Typically, you have a higher probability of doing auto-enrollment, auto-escalation if you're a larger employer, and typically you have more generous employer matches and contributions if you're with a larger employer. So all of that gets factored in. And I'm going to start you out by my bar with the people at the very last 3 bars. The one that says auto IRA at 3%, no opt-out. I have no idea if you have an auto IRA, and this is something that states are currently struggling with, is what percentage of the employees opt out. So this is the best case scenario, that if everybody gets put in at 3% and does not opt out, I can basically take that $4.13 trillion or 4,130 billion deficit that I came up with, and I can reduce that by $268 billion if I do the federal auto IRA and nobody opts out. Now, not surprisingly, if I go with the ARPA, the Automatic Retirement Plan Act of 2017, and again assume nobody opts out of that particular scenario, then we have a much larger overall reduction of deficit up to $645 billion. And again, the reason this happens shouldn't be surprising, because we're defaulting you at 6 instead of 3, and then we're also doing the auto escalation up to 10%. I will say, and if you look at the issue brief, the caveat is made clear in the footnotes that one has to at least deal with the fact that we have a situation going on where if you basically default somebody at 6% instead of 3%, then you're going to have a situation where you would most likely have a higher probability of opt-out. But again, we're assuming that there's 0 opt-outs in this particular case. Okay, and then finally, if I go down to the last row, this is my universal defined contribution scenario. Now, huge caveat here. The other 2 that we just looked at assume no opt-outs. When I did the universal defined contribution scenario, I was able to use the information that we have in our 401k database. So these are based on empirical observed contributions and opt-outs. So whereas in the best case scenario we had for auto IRA and for ARPA at 0% opt-out, here what I'm doing is not an apples-to-apples comparison, but even in that case where we're using the empirically observed opt-outs, we get up to an $802 billion overall deficit reduction. And I'm looking at a white screen.
There we go.
Okay. So all the numbers above that basically will look at either the auto IRA or the ARPA under different opt-out scenarios. And as you might guess, the larger the opt-out assumption, the smaller the overall reduction in the retirement deficit. So if you want to compare apples to apples, you might want to compare the universal DC, for example, with maybe a 10% or 25% opt-out under one of those other two proposals that we mentioned. Okay, so figure 6, exactly the same three scenarios I talked about on the previous figure, but now instead of basically putting everybody together and just talking about aggregate dollar values, doing that? Okay, back to figure 6. Instead of putting everybody together and talking about aggregate deficit values, here I do the breakouts by age, and I'm just giving you the percentage reductions. So once again, if we could look at the column on the left-hand side, we'll pretend the green arrow is actually working. If you look at the columns on the left-hand side, where I'm only looking at the people 35 to 39, you see that, as you would guess, the youngest individuals have the highest likelihood of benefiting for the longest period of time. And under the auto IRA with a 0 opt-out, you have a 10.6% reduction in retirement deficits for those 35 to 39. Under the ARPA proposal, you more than double that for the youngest age cohort, and you see there's a 23.4% reduction. This is the middle number on the left-hand column. And again, only as a comparison point, if you look at the universal defined contribution scenario, for that youngest cohort, 35 to 39, the ones that we modeled that would have the longest period of time in this particular new scenario, we get it up to a 28.2% reduction. So I think those are very impressive numbers. Obviously, if you go to the other end of the age spectrum, it shows you what I think you would have expected if you're just literally years away from retirement, if 60 to 64, that going to any one of these, whether it's the auto IRA, the ARPA, or even the universal DC, it's not going to make that much of a difference in terms of your retirement savings shortfall reduction or your retirement deficit reduction. Now, moving on to the whole concept of leakage, this is going to be the only chart where I'm not using the retirement readiness ratings or retirement savings shortfalls. It's extraordinarily difficult to basically show the impact of leakage when you have that stochastic decumulation module going on at the same time. So for this one case, I'm going back to a much more conventional benchmark of success. And what that is in this case is, are you going to have enough between your 401k account, any IRA rollovers that originated in the 401k, plus your current statutory Social Security benefits? Put all those together, assume that you buy an inflation-adjusted annuity with the first two. Do you have enough to replace on a real basis at least 80% of your income the year before retirement? Now, what I'm going to be looking at when it comes to leakages is I'm going to be looking at 3 different components and then putting them together. So if you're following along on the grid, the one on the top, the one in the blue, is basically the loan defaults. The next one was hardship withdrawals with, at that time, the 6-month suspension that was required. And then the final one is the cash outs. Now let me focus on the lowest income quartile, the one on the left-hand side, and walk through each of those numbers for you. This is basically telling you what percentage of people would have had a 80% replacement rate on a real basis or higher had it not been for that particular leakage component. But because of that leakage component, they didn't make the 80% cutoff. They might have missed it just by a little bit, but they still ended up missing it. So if you're in the lowest income quartile, 4.2% of those individuals are going to end up missing it because of loan defaults. If you go down to the number right below that, that 8%, that says for the hardship withdrawals with, again, the 6-month suspension that was in place at that time, 8% are going to miss it. But both of those, even in combination, are much less than the third component, which are the cash outs. These are the people who, upon job change, don't roll over their money to either another employer-sponsored plan or an IRA. They just cash it out. And we see that fully 20% of the lowest income quartile that missed the 80% threshold, who would have had it otherwise, are missing it because of the cash outs. Now, if you combine all three of these together, obviously there's going to be interaction, so you can't just add the three numbers above it, but we end up showing that more than a quarter, 27.3% of the lowest income quartile who would have hit the 80% threshold had it not been for leakages end up missing it because of leakage. If you want to scan over from the left-hand column to the others, go all the way to the right-hand side, you see the highest income quartile. Basically, the same relative contribution in each of the leakage cases, each of the leakage components, but in each case you get smaller numbers. So where you had a 20% hit on cash outs for the lowest income quartile, it's down to only 10% for the highest income quartile. And I think most people who are familiar with what cash out statistics look like, either as a function of age or as a function of income or as a function of account balance, realize that that's exactly what's happening in the real world. One thing I should have mentioned, I'm sorry, in the subtitle of this is being limited to only people with 30 years of simulated defined contribution eligibility. So we wanted to look at people who had more or less a full career of eligibility in a DC plan. So figure 8, what we wanted to do here was to take a look at one of the suggested solutions for dealing with the most dire leakage component we saw from the previous graph, that of cash outs. And what we're going to look here is what happens if you would have some kind of auto portability solution put into place. So when people leave a job that had a 401k balance, in essence, there's not going to be cash outs because they're going to be automatically ported over to the next employer they have who has a retirement plan. So we more or less drive cash outs to zero. I'm assuming there's no leakages from the auto portability system. Obviously, that's something that would have to be empirically verified if we ever did have something like this. But again, let me focus for you on the left-hand columns, the youngest age cohort. What we find here, because I break it out by years of future defined contribution eligibility once again, that if you've got 1 to 9 years of future eligibility in a DC plan, that the auto portability can reduce your retirement savings shortfalls, your present value retirement deficits, by 17%. As you would guess, the more years of defined contribution eligibility you have going forward, the larger the probability that you're going to have a reduction in the deficits. And we find that with auto portability by itself, and note, I'm not combining this with the auto IRAs, I'm not combining this with the ARPA scenario, I'm not combining this with the universal DC scenario. I mean, all those things could be put together, but auto portability by itself for the youngest age cohort would end up reducing the retirement deficits almost by a quarter. We get up to all the way up to 23%. Okay, then the last two slides, the last two figures, excuse me, I want to take you through are just basically dealing with the 402G limits and the 415C limit reductions. On figure 9, I reduce it down from $18,500 to $12,000. I didn't do any catch-up modifications. That $12,000 isn't coming from any specific proposal. I just thought it was representative of the types of proposals, types of suggestions we've heard in the past. And what I've done is I've given you percentiles. So if you want to look, for example, at the 10th percentile, the blue line on the left-hand side. Oh, by the way, the left-hand side is I'm assuming an auto-escalation up to 10%. The right-hand side is up to 15%. If you want to look at the blue line, for people 26 to 35, what I'm saying here is that at least 10% of them are going to have a reduction in their account balances by at least 12%. If you want to look at the red line, the 20th percentile says at least 20% of them will have a reduction of about 6.5%, and there's about 1%, again, of the youngest age cohort here, 26 to 35, that'll have about a 1% reduction in their overall account balances at age 65 as a result of this. If you move over to the right-hand side, if I allow that auto-escalation to go all the way up to 15%, as you would expect, all the numbers increase correspondingly. You've got 10% that are going to have about a 15% reduction. Again, this is the youngest cohort. You've got 20% that are going to have at least an 11.5% reduction. You've got 30% that are going to be about 8.5%, and 40% of the individuals will have about a 0.5% reduction in their account balances at age 65 as a result. One important caveat, if you look up in the title, I'm not assuming job turnover in this particular set of runs. We do include that when we do the full simulations, but I was just looking at this one particular component. And then for the final figure, we looked at what happens if the 415C limits went down from $55,000 to $30,000. Again, I didn't do any catch-up modifications. And again, this assumes no job turnover. If you look at the blue line in this case, you see that for the youngest individuals, there's about a 25% reduction for, at least 25% reduction for 10% of the population. That's with an auto-escalation up to 10%. If you go over to the right-hand side, you see that with a 10% of the population would have a hit of at least 1/3 on their account balances at age 65 if you had such a drastic 415C limit reduction. So to sum this up, the purpose of the issue brief, and it should be available to all of you now on the website, is just to examine the impact of various retirement reform proposals on all U.S. households. And a thing I cannot stress enough, this is every U.S. household, whether or not they're covered by an employer-sponsored retirement plan or not. Again, as we showed you in some of those early graphs, whether or not you're eligible for a DC plan has a huge impact on both your probability of success as well as your present value retirement deficits. So just keep in mind, you can't take these numbers and extrapolate it only to 401k participants. Overall, 401k participants are in a much, much better situation. It's important to understand that these percentages, like I said, apply to all the U.S. households in that age cohort. Eligibility to participate, employer-sponsored retirement plan are typically in a much better position. Thirdly, the issue brief analyzes the potential impact of several proposals on the current aggregate national retirement shortfall of $4.13 trillion. We saw that an auto IRA with a 3% deferral would reduce the shortfall by $268 billion in a best-case scenario where there are no opt-outs. ARPA would reduce it by $645 billion if there were no opt-outs. And in contrast, a universal DC system would decrease it by $802 billion, but again, that's not an apples-to-apples comparison because we're assuming empirically derived opt-out rates in that particular case. And then finally, to finish the summary, although these proposals are going to have a substantial impact on younger cohorts, there would be very, very limited relief for those on the verge of retirement, and I give you the statistics below. We looked at the forms of leakage, cash outs, hardship distributions, and loan defaults, and we analyzed their potential impact on workers currently 25 to 29 who would be simulated to have more than 30 years of eligibility to participate in a 401k plan. And basically we compared that with a 80% real replacement rate, and we saw that the percentage of workers impacted by the three types of leakage combined went anywhere from 15% for the highest income quartile up to 27% for the lowest income quartile. I really want to stress that next bullet point, that caveat, that we can't therefore assume that if these forms of leakages would be removed that we'd automatically see those changes. You have to consider there's going to be behavioral responses. For example, there might be lower participation and contribution rates, especially among the lower income groups, that would at least partially offset those improvements, because many of these individuals are probably contributing, participating, because they currently believe they'll be able to either take out a loan, take a hardship withdrawal, or at job change, for example, if they're unemployed involuntarily, that they believe they'll be able to get that money prior to retirement age. So there's going to be at least second order impacts that are going to be modeled if you're going to look at that overall impact. And then finally we found that under the auto portability, we could reduce those retirement shortages for the youngest cohort we looked at, 35 to 39, anywhere from 17 to 23%, depending on the number of future years of eligibility to participate in a DC plan. The last slide, I just wanted to give you a bit.ly URL if you're interested in more information. Craig and I have done approximately 40 different studies using the retirement security projection model, and that takes you to a web page on the EBRI website that gives you links to I think, all of them. If there's anything that I didn't leave a link for, just feel free to send me an email at vanderhei@ebri.org, and I'll shoot that over to you. So with that, Brett, I guess I'm turning it back to you.
Well, Jack, that was a tour de force and a tour of a really important model with a lot of moving parts and policies that you've examined. This is wonderful. What we want to do right now is open this up for questions. I actually have a couple that have come in, and I have a couple of my own. So please don't hesitate to write your questions in the bar and send them in. So while we're waiting for more, Jack, why don't we start off with one, just a very simple thing. Can you explain the Automatic Retirement Act of 2017 for the audience? There seems to be a little uncertainty about that. What is it, and why is it labeled 2017 if it hasn't passed?
Well, as I thought I said, it was a proposal, not legislation. But basically, it was a way of trying to get almost like an auto IRA type scenario through, but at what was perceived to be deferral rates that were going to have a higher probability of producing adequate retirement income. Again, you started at 3 and stayed at 3 under the original auto IRA proposal, and basically this will start you out at 6, auto escalate you up to 10, and then basically come back after 3 years if you opt out and put you back in again. The important common point between ARPA and the proposals for a federal auto IRA is that there were no employer contributions involved. So again, it's going to the employers who had decided not to set up a plan, and basically it's not requiring them to make any contributions to their employees. It's just to put them in an IRA, although in this case at a much larger deferral rate with the auto escalation, and every 3 years coming back to those who had opted out.
And so what we can see is that this proposal responds to the sort of overall coverage rate in the United States, which is which you could characterize as not 100%, way less than that. And there are many employers who haven't decided to create a plan. And then if you create a plan, or if you have this automatic IRA, you then get that's based the conditions are based on the research that says if you default people into things, they're more likely to not to opt out and do what you might think is the right thing. So I guess that's where all that is coming from. So we have we have several other questions that have come in. Somebody says, well, wait a minute, ARPA is really an automatic defined contribution plan, not an IRA, but I guess the principles are still the same. Anyway, let me ask one let me take the moderator's privilege and ask one. So, Jack, let me focus you a minute on long-term care. I heard you say right in the beginning just how sensitive the whole system is to long-term care costs. And so I actually have a two-part question. One, did I get that right? When I say the system being sensitive, I mean the failure rates or the shortfalls. Are they particularly sensitive to long-term care compared to other factors in your model? And second, how do you deal with long-term care? Because isn't that a bimodal kind of distribution? There are people who are going to need it, and that really drives up the cost. And then there's a bunch of people who don't need it, and therefore they have very few extra costs. So kind of a two-part question.
Well, I'll do the second part first, if you don't mind. That's exactly why we have to have both deterministic and stochastic components of our decumulation module. So every year we will, for either the single person or for both individuals in a couple, simulate whether or not somebody is going to need long-term care, whether they go into a nursing home, home health services, etc. If they do have a simulated event, then we also simulate how long that event is going to take place. And then if they live through that event, so let's say we simulate you're going to be 5 years in a nursing home and then come back home, we have a completely different set of probabilities that are going to apply. So there's going to be a different mortality probability, a different probability that you're going to go back into the nursing home, et cetera, et cetera. We run that every single year, and you're absolutely correct that if you would look at just that one component of overall cost of retirement, you come up with a very skewed bimodal distribution. Now, the problem is you don't know going into this if you're going to be one of those unlucky few who have catastrophic long-term care costs, or whether you're going to be the lucky part of the population that can go through your entire retirement and not have long-term care costs, or only have manageable long-term care costs. And that's why, from an insurance perspective, I'm not going to say there's necessarily a great insurance market for this, but from an insurance perspective, what we found when we compare all risk management techniques at retirement age, that from a cost-benefit perspective, there was nothing that even came close to having a comprehensive, catastrophic long-term care insurance product. Because again, like you mentioned, you're interested in those tail risks. And to the extent that you can at least cover those tail risks at a somewhat moderate cost, the converse of this is there's nothing that we've looked at that is more damaging to a household at age 65 who looks like they have adequate financial resources, that ends up running short of money in retirement, than long-term care costs. It's much worse than longevity risk, and it was much worse than the post-retirement investment risk. And I forgot your first question already. I'm sorry.
Oh, I think you just answered it.
Okay.
It's how sensitive is the system to this, and I think you just answered that. Okay. So the next one is really about this is another one from the audience, and that's about housing. So people have a schizophrenic attitude about their house. It's not an asset, it's a place to live, and then it can become an asset. So how do you guys deal with that, and what percentage of any of your deficits is solved by accounting for housing equity?
Well, in the beginning, we thought it was going to be a situation that was going to be too controversial to assume people were going to use net housing equity to finance their retirement, so we left it out. And then we went out and did these presentations for the various states, and we were told in no uncertain terms that no, this is why people invest as much as they do in their houses. So we developed two alternative ways of looking at this. One was we just assumed everybody at age 65 sold the house, purchased a reverse annuity mortgage. And the third one, the one that we've now moved into our baseline, is that if you have a house when you retire at 65, we assume you stay in it absolutely as long as you can afford it. You can't afford it when you basically run down your DC and your IRA balances to zero and you don't have enough money from Social Security and DB to pay your expenses. So then and only then do we assume that you sell your house, you take the net proceeds, you put it in a non-tax advantage account, and you move from a house to a rental situation. So you accommodate all those various transaction costs, but at least now you have another $50,000, $75,000, $100,000 to live on, and if that will take you out through the end of your life, fine. If not, what you've done is basically defer your date at which you run short of retirement, run short of money in retirement.
You know, let me just point out, let me make an editorial comment. There are very few folks out there who have treated housing in this way. And just two comments. One is that until the post-war era, people actually used to behave that way. They'd buy a house and they had a family if they could afford it, if you're middle class. And then then there'd be a very typical pattern where they sell it and move into an apartment after the kids are gone. The second thing is that is very sensitive to the notion that people treat their house as you know, for its use value, just to be a Marxist about this, until they can't afford not to treat it as use value, and then all of a sudden it turns into an asset. And that's been a belief of mine for a long time, and this is a sensitive way of getting at that. Here's another one, Jack. What are forward interest rates? What are the interest rates that are used here in your model?
In terms of, what are we talking about? Investment rate of return, or
It wasn't clear from the question, but is it you know, might be discounting, it might be investment rates of return. I'm not sure. It said forward interest rates.
Well, let me do the investment rate of return, because that's what I think comes up most often. In the beginning, Craig and I used a lot of assumptions other people had put together as far as future rates of return. And if there's 20 consulting firms out there, 19 of them would consider what I did silly because I didn't use theirs. What we ended up doing was being completely agnostic, and we use historical returns from Ibbotson. We transform it into a log normal distribution, and basically run typical Monte Carlo based off of that with investment fees factored in. What was the second part? I'm sorry, I forgot what else.
Oh, it was actually discount rates, but the other thing, the same person just wrote back and said, what about inflation rates? And so did you treat the inflation rates the same way?
Yeah, what we do for inflation is basically use the intermediate under the Social Security Trustees report to bring everything back to present value terms.
Got it. That's okay. And so let me go on to another very different question. You saying that you did estimate the impact of lower 402G and 415C limits on account balances at 65. What are the impacts on retirement readiness? So just keeping in mind for the rest of the audience, we all realize that Jack has modeled the outcomes in very different ways, and he can do it in even more ways than we saw, like income replacement ratios and so forth. So I think this is really a question about what's the best way to see the impact of something like limits on 402G and 415C.
Well, we did not go the next step and throw that into the model to do either the retirement readiness ratings, probability of success, or retirement saving shortfalls, or present value of deficits, because again, you have only a percentage of the population that'll be in a 401k. You have a smaller percentage that's going to be hit by the 402G or 415C limits. So if you're going to be looking at the entire universe of households between 35 and 64, the overall change in, let's say, the retirement savings shortfalls, present value deficits, is very, very muted. So what I wanted to try and do is look only at account balances. I could easily show that instead as account balances divided by terminal earnings. I could convert that to replacement rate. I could basically run it any way somebody would like to see. Probably the most efficient way of doing this, though, if you would like to see things like probability of success or present value of deficits, is to do it only for current 401k participants. Much of the Rothification analysis that we did last year, obviously we only looked at 401k participants. Changing from the traditional system to a Roth system obviously has no impact on anyone who's not a 401k participant. So I could basically show those results in exactly the same kind of way if anyone's interested.
I'm sure there would be when the Roth proposal comes back. There's going to be a lot of interest in this, I suspect. So we have about time for one more question, and that really is, well, because I think there's more interest, or at least there's some intense interest in the Automatic Retirement Act of 2017. Could you say anything about tax credits for small employers and open MEPs? Did you guys look at anything like that, or have you just summarized everything you did look at?
No, we put the whole package together, but as far as comparing the changes within the plan design vis-a-vis the federal auto IRA, basically those were the most important. We went back and also have other information in there if you like it separated out on things like the open MEPs, the annuitization provisions, et cetera. But that was the part that was most common characteristic to the other things that we just presented today.
Okay. Look, we're right at the end of our time, and what I want to do as moderator is thank Jack very much, and I hope you'll all join me in thanking Jack. That was a real tour of some very deep stuff, and there's lots more to think about, and I know there's lots more resources that all of us can look for on the EBRI website. Jack, thank you very much for everything.
Thank you, Brett.
And I'd like to add my thanks to Jack. This has really shown the power of the retirement security projection model. And going forward, we will be looking at additional uses of this model in looking at things like the state initiatives that are out there and are proving a very interesting experimental ground for different ways of solving the retirement deficit. Thank you to Brett and to University Conference Services for hosting. And please do join us next week for our next e-briefing, which will be on Retirement Confidence Survey, Retirement Savings and Preparation. We are already sold out on that. It's next Thursday, June 28th. But we will have replays available if you did not have the ability to sign up because we're sold out. And if you are an EBRI member, email us at info@ebri.org, and we will get you in to that webinar next week. And finally, sign up for EBRI at ebri.org to get all of our research and keep abreast of our webinars. And thank you very much to all. Have a great day.